Welcome to the online classroom for the module FIN4801, Advanced Financial Management. In this class, I'm going to be taking you through the June 2022 FIN4801 past paper. So what I'm going to be doing, it's just going to be revision and exam preparation. I'll be taking you through this paper, telling you some important concepts you need to be familiar with for the purposes of the exam, and just giving you some general advice as to how to approach this particular exam. So that's how I usually do it in my revision class. I go through some papers, give you advice, remind you of some important concepts as you get ready for your exam and you prepare. So in this class, I'll be taking you through the May-June 2022 paper. Okay. So the May-June 2022 paper was a 4-hour paper. That's very long. So you need to be prepared for that. Most papers are usually 4 hours, 3 hours, sorry, for other modules, but this is a 4-hour paper. So it makes it longer than the average paper. So it requires a lot of concentration. And then what you'll find with this paper, usually you'll have the first question consisting of some MCQ questions. It could be 4 or 5 questions. In this particular paper, it was 3 MCQ questions, just asking, taking you through some theory. And then usually there'll be a capital budgeting question. In this case, the capital budgeting question was a 20-mark question. And then you might get different types of questions, maybe with, you see question 3 is also 20 marks, but it's broken down into a number of questions for 8 marks, 7 marks, 5 marks, and so forth. Question 4, 15-mark question on the net advantage of leasing. Question 5, 12-mark question broken down into many small questions. And then question 6 is a question on capital structure, right? And then question 7 has to do with different ways of paying dividends using the residual approach to dividend payments. So we're just going to be going through this paper. I'll be giving you some important points you need to take notes of for the exam, what to focus on, and then hopefully that will help you. So we can start. So question number 1 is an MCQ question that says, the following 3 questions are multiple choice and require you to write down the question number and then your answer selection. Okay, one other important thing, right, to note is, because this paper is a 4-hour paper, it means that approximately you need to spend about 48 to 50 minutes at most on a 20-mark question. So you need to spend about 45 minutes on a 20-mark question. So that will just help you in the exam. Once you start the exam, if you start with question 2, if it's 4 hours, this should take you about 45 minutes. Question 3, another 45 minutes or so. Question 5 is just 12 marks. But questions usually 20 marks equates to 45 minutes so that you don't run out of time. Okay, so let's start. Question number 1 says, when analyzing the cost of capital of a company, which of the following mixtures of costs and weights would be most appropriate? This is a simple bookmark question. We know that when we are analyzing the cost of capital, ideally we should use market weights, and we should also use market costs, because usually the market weights and the market costs represent what investors are requiring to put money into the company. And it also tells us how much the finance that's been put into the company, how much it's worth. For example, should the company go into liquidation, what is the value of the company? So we are concerned with market values, which give us market weights, and we're also concerned with market costs, because those would be the costs of raising extra finance for the company rather than book weights and book costs. These are related on historical figures, which are not relevant for raising incremental finance. So the correct answer there is we are concerned with market weights and market costs. That's important. So whenever we're calculating the weighted average cost of capital, we ideally want to use market weights and market costs, but there are times where you don't have market weights, then you can resort to book weights. So ideally, we should always strive to use market weights and market costs. Question 1.2 says, if irrational investors' exuberance leads to an overvalued share price in the eyes of management and shareholders, and in the eyes of shareholders, on the eyes of management and shareholders do not push for new unplanned investments, what would be the best way for management to act with regards to raising funds? In other words, in this particular case, the shares of the company would be selling for, let's say, 20 Rand, but based on valuations by the company, the shares are actually worth 15 Rand, right? So we are being asked, what would be the best way for management to act? So we can see the share prices are overvalued. How can management benefit from the share prices being overvalued? So the options are raise equity finance whilst the share price is high, wait for the share price to fall to raise funds, issue bonds and use the proceeds for a share buyback, initiate a share buyback. So usually when the share price of a company is overvalued, it's usually the best time to raise finance because you don't have to issue as much shares as when the share price is low, and that prevents the dilution of shareholders' interest. So in this case, we would say the best option is to raise equity finance whilst the share price is high. This limits the number of shares that actually have to be issued, which limits the effects of dilution of the current shareholders' ownership of the company. Remember, issuing a lot of shares dilutes the current shareholders' ownership of the company. So that's important. And then let's move on to the next question. So I'm also just giving you some background as to everything we're covering here. The next question says, Company Z is planning on acquiring Company A through a share issue. The market price of Company A's shares is 10 Rand, while the market price for Company Z shares is 50 Rand. Company Z wishes to propose an exchange ratio of 0.3. What would the market premium offered by Company Z be if it proceeds with this offer? Now, this is a simple case of calculating the market premium. It falls under the chapters of mergers and acquisitions. It's a matter of just identifying the correct formula and then substituting in that formula. So in this case, we've been given an exchange ratio based on market share prices. Remember, sometimes you also have exchange ratios based on the EPS. So we're being asked to calculate the market premium, right? So the formula we use is as follows. The market premium is simply the market price of the acquiring company times the exchange ratio divided by the market price of the target, the company that wants to be purchased, minus 1. And then if we substitute these values and calculate, we get 50%, and that gives us the corresponding market premium. Okay. Then we move on to question 2. Now, question 2 is one of the first long questions you will come across in the exam, and you have to really concentrate on this capital budgeting question, and you need to understand the different ways this question can be asked, how to approach this question, the steps to take to make sure that you don't make any mistakes and you don't go wrong. Okay. So we'll cover this question, and then in other revision classes, we'll look at other capital budgeting questions, and then that will help us with regards to the best approach to use when we face these particular types of questions. Okay. So this question says, Powerless Limited is a recently formed company aiming to provide alternative energy solutions to a broad market. The company currently imports and sells primarily Chinese-built solutions However, it is in the intermediate stages of planning to build its own local assembly line. The most favored plan amongst management is to purchase components overseas and to then assemble inverters, solar panels, and battery packs locally, which will require an initial investment of 40 million rand. Based on the sales of the current imported equipment and the expected cost of local assembly, the company expects sales generated by the plant to be as follows: year 1, 40 million, and in year 6, 80 million, and in between it's 80 million, 60 million, 70 million, 100 million. Cost of sales is expected to amount to 80% of sales, and the initial investment will be written off over 5 years through the straight line method for tax purposes. At the end of the project, in year 6, it is planned that the company will transition to full-fledged local manufacturing and sell the plant at an expected amount of 20 million rand. The corporate tax rate is 27%, and all the values provided are in nominal terms. So Powerless Limited uses its WACC of 12% as a discount rate, but adds a risk premium based on the coefficient of variation of the project's expected cash flows. The planned project has a CV of 0.7 associated with its cash flows. The risk premium is allocated as follows. And then we're given how to allocate the risk premium. Remember, the discount rate we use to discount cash flows depends on the risk that the project is exposed to. The higher the risk the project is exposed to, the higher the discount rate that we'll use to discount the cash flows. So an increase of 10 million rand in net working capital is expected for the project, and it is expected that 15 million in net working capital will be recouped or recovered at the end of the project. Then we are asked to calculate the NPV of the project, comment on the acceptability, profitability, and risk of the project. All values provided are in nominal terms. Okay. So for this particular type of question, there are 2 parts to the question, right? There are 2 important parts to the question. The first part of the question is we have to calculate the tax expense for each particular year. Okay, we have to calculate the tax expense for each particular year. And then, okay, first part, calculate the tax expense for each particular year. And then after that, we'll fix this. Tax is actually supposed to be 27%. I'll correct this shortly. And then after that, we then need to get the net cash flow for each particular year. Okay, I'd use the tax rate of 28%. I'm going to fix this quickly. We are supposed to use 27%, as we've been told here. So we have 2 things we need to do. Firstly, we need to calculate the tax for each particular year. And then after getting the tax for each particular year, we can then calculate the net cash flow for each particular year. And we will use that tax we will have calculated here to help us to calculate the net cash flow for each particular year. Okay, so we now have the proper tax rate of 27% and everything is fixed. So to calculate the tax rate, you have to recreate your income statement. And of course, your income statement starts with your sales, and then it has your cost of sales, then you get your gross profit, then you subtract your depreciation or any other operating costs if you're given. Okay, so let's start here, right? So with regards to calculating your gross profit and subtracting your depreciation, it's really, really important to read the question carefully. The question will guide you as to the approach you're supposed to use when you're calculating your gross profit and subtracting depreciation. In this case, we were given our sales, then we were told cost of sales are 80% of sales. So when we subtract cost of sales from our sales, we get our gross profit. So here, you won't always be given the same information. Like, information will change from question to question. So you have to read carefully how you calculate your cost of sales. So in my case, I took my sales, then I multiplied each of my sales by 80% to get the cost of sales. And then I subtracted to give me my gross profit. And then with regards to depreciation, I was told that depreciation is depreciated over 5 years using the straight line method. So for tax purposes. So what we do there, see it's written off, so it's depreciated to a book value of 0. So we take the installed cost of our assets, we take our initial investment of 40 million, be sure to check if there are any delivery or installation expenses, and then those are also added to the initial investment. So here we've been given the initial investment already. There's no need to add anything else like delivery and installation. So we just deal with this particular amount of 40 million. And then we need to divide that amount by 5 years, because it's depreciated over a 5-year life. So you'll notice that our depreciation will end at the end of year 5. Year 6 won't have any depreciation because we assume that the life is written off over 5 years. So these are things that can change from question to question. It can be straight line depreciation. It can also be depreciation where we subtract certain percentages of the initial investment each year, whereby maybe the first year 1 depreciation is 30% of initial investment, year 2, 20%, year 3, 20%, and so forth, with different percentages. Okay, so that's the first part of your income statement calculation, right? So you then also always need to check if there are any fixed costs or other operating costs. In this case, we were not given any other fixed costs or operating costs. Those would also need to be subtracted from the gross profit before we calculate our taxable income. And then lastly, you have to look at recoupment. So there are 2 types of recoupment we can look at here, right? Firstly, it's possible that at time 0, we can sell an existing asset. Sometimes it's possible that at time 0, we can sell an existing asset for a particular amount. In this case, we didn't have any existing asset we were selling, right? But if you did have an existing asset you were selling, you would need to include its recoupment amount here. In other words, you would need to include its market value less the book value. That would be the recoupment, to see how much tax we have to pay, right? For example, if our book value was 0 and we could sell the asset for 200,000, then our recoupment would be 200,000 minus 0, and we would put 200,000 here. We would be getting some income from selling an existing asset. Likewise, for the existing asset, if the market value we can sell the asset was 400,000 and its current book value maybe was 100,000, we would say 400,000 minus 100,000, giving us a profit of 300,000, which would then need to be taxed. So we would put that as our recoupment. Okay. This rarely ever happens in exams, but it could come. So you need to be familiar with it. But I haven't seen it coming up in exams lately, but it's an important concept. Recoupment of the existing asset can occur at time 0, and you need to account for tax. And that's very, very important. But in this case, we didn't have an existing asset we were selling, so we didn't have any form of profit, so there was no taxable income here. So we just leave it here as blank. But the new asset can be sold at the end of its life for 20 million, right? This manufacturing plant can be sold for 20 million, and it would have been depreciated to, it would have been written off, depreciated to a book value of 0. So the recoupment on that asset, the new asset at the end of its life would be 20 million. So we put that 20 million right there. So it's always important to check to see if you have recoupment. It's really, really important. If your recoupment, so you need to make sure you account for your recoupment. It's really, really important. And then once we've accounted for our recoupment, we can now calculate our taxable income. we simply take our gross profit less depreciation, and then we add our recoupment if we have any. At time zero, there was nothing. So we just do our calculation here for each year, and then we calculate our taxable income, right? So we get the taxable income year 1, year 2, year 3, year 4, year 5, and year 6 by simply taking our sales less cost of sales. We get gross profit less depreciation. At recoupment, we get our taxable income. Then we multiply our taxable income in each year by 27% to give us our tax expense, right? And then once we've got our tax expense, we can then now proceed to the next part of the calculation, okay? The next part of the calculation is when we actually now calculate the net cash flows for each particular year. For this particular question, we start with the installed cost of our asset, right? We then take our sales for each year, less our cost of sales, less any operating expenses except depreciation. Sometimes you might have fixed costs by themselves or operating costs by themselves. We would subtract them, but we don't subtract depreciation. Depreciation is a non-cash expense, so we don't subtract it. We only subtract the cash expenses, which are expenses like our cost of sales, fixed costs, and so forth. So we say sales, less cost of sales, less fixed sales, okay, there, and less operating costs, if we also have operating costs. Okay, so once we've done that, we can then subtract. Okay, the next thing we now have to account for is our residual value. In this case, this is the residual value, the market price of the new machine at the end of its life, right? It's possible we would also have the residual value of the current machine. It's possible that we could also have a current machine, and then that current machine would have a residual value associated with it, right? And then we would need to add that because it would be money coming in, right? We've already accounted for the taxation of that. If we add a current machine, we will have accounted for the taxation above, just like we accounted for the taxation of this machine in our calculation here, right? And then lastly, we account for our working capital. We're going to have an outlay of 10 million in working capital immediately at time zero. And then that working capital will be recouped at the end of the life of the project. So we also, remember, working capital expenditure at the beginning is an outflow, then recoupment, recovery of that working capital. In this case, we will recover it, it's 15 million, whereas the outflow is actually 10 million, right? And then lastly, whatever tax amounts we got above here, we take those taxation amounts and we put them here, and then we subtract them. And then that will give us our net cash flow. So that will be installed cost, less work here, and our working capital. Our net cash flow times 0 is 50 million, 40 minus 32, 8. 80 minus 64 minus 2.160, we get this amount, that amount, that amount, and so forth. So this is the basic idea behind calculating these cash flows. If you stick to this template all the time, you will not struggle with this question in the exam. You just have to be familiar with some of the possible changes that could occur with regards to the question, how to calculate your cost of sales, how to calculate this or that. Sometimes you also have to adjust your sales for inflation, but we will look at that as we revise more papers and as we go through more memos. So once we have our net cash flow, we can now move on to calculating our net present value using the appropriate discount rate. So in this particular case, we were told that the coefficient variation of this particular project is 0.7. And we've been told that if our coefficient of variation is equal to or greater than 0.61, then our risk-adjusted discount rate would be 1.5 times the WACC. that will account for the risk premium. So in this case, we would say 1.5 times 12 is equals to 18%. The way this question was worded can be a bit confusing. It might be possible to assume that we say 12% plus 18% as the risk premium, but I've seen an assignment memo with this particular question. And with a similar type of question, not the same, but a similar type of question. And the way we had to account for the risk-adjusted discount rate and the risk premium is simply to take 1.5 times our WACC, which is 12, giving us 18%. So the appropriate discount rate to use in this question, given the risk of the project, is 18%. Once we have our cash flows and the appropriate discount rate, we can then calculate our NPV. It's just a matter of correctly using our financial calculator, and we get 2,368,413.30. So you'll notice with most of these capital budgeting questions, right, at the end of the question will say, calculate the NPV and then comment on the acceptability, profitability, and the risk of the project. So you likely have to write a really short paragraph just explaining whether you would accept or reject the project, also stating whether the project is profitable or not. Obviously, if you accept it because NPV is positive, it means it's profitable. Likewise, if NPV is negative and you reject it, it means it's not profitable. And then we adjusted our discount rate by multiplying it by 1.5. So we had a higher discount rate than the WACC. So it means that this is an above average risk project. Remember, the higher your discount rate, the riskier the project. And the lower the discount rate, the less risky the project. So that brings us to an end of this capital budgeting question. Please note, it's important to note that these capital budgeting questions are not always the same. They change. So it's important to go through as many questions as possible as you prepare for your exam, to familiarize yourself with the different ways in which this type of question can be asked. So this is just one possible example of how a capital budgeting question can be asked. Okay. Okay, so we can now move on to question number 3. Question number 3, rather than being one long 20-mark question, it's actually a number of short questions. One just explaining the effects of changes in credit terms. The other one focusing on estimating the company's need for funding. And lastly, one just asking us to compare different types of funding requirements. These are typical questions you get in assignments over the course of the semester, and they also come up in a number of exam questions. So let's look at question 3.1. High Street Limited sells apparel and accessories in retail outlets, with all their clients utilizing store credits due to the favorable terms offered. Currently, the company has sales of 90 million rand per annum with a gross profit margin of 50%, while offering favorable repayment terms of 120 days to make payment with no interest charge. Bad debts currently amount to 8% of sales, leading to current days sales outstanding of 150 days. The financial manager of the company wants to change the terms to 10/1386. Remember what this means, right? This means, I just want to explain some of these concepts before I continue. This means if credit debtors settle their account in 10 days, they get a 30% discount, right? But they are supposed to settle their account within 60 days. Sorry, let me quickly correct that. What I actually meant to say is that this statement means that customers get a 10% discount if they pay within 30 days. But if they don't pay within 30 days, they get no discount, and we give them a maximum of 60 days to pay. So in other words, if a good is sold on credit today, right? If you pay within 30 days, this company will give you a 10% discount. But the maximum days of credit they've given you is 60 days. So if you pay in between 30 and 60 days, you get no discount, right? If you pay here, no discount. But if you pay between 0 and 30 days, we give you a 10% discount. So we've given you 60 days to pay your debt. If you pay within 30 days, we give you 10% discount. If you pay between 30 and 60 days, you get no discount. So if you now go above 60 days, it means that you have forfeited you've like gone against the credit agreement. I was just correcting that. I mistakenly said this initially the other way. So it's 10% discount if you pay within 30 days, but you get a maximum of 60 days to pay, right? And then currently on average, clients are taking 150 days to pay. That's the current days of sales outstanding, right? So the company wants to change its credit standards to take these current days of sales outstanding down to 70 days. It's currently 150 days. They're saying customers are taking too long. 150 days is too much. So we want to try to bring down the day sales outstanding to 70 days, right? Because 150 days is too long. We want to bring it down to 70 days, right? And then we're told what will happen is that currently bad debts amount to 8% of sales, but by changing our credit standards, our bad debts are going to increase by 1% to 9% of sales. And it is also expected that the discount on offer on early payments will lead to sales increasing to 100 million and will be taken by about half of all customers if the terms are adopted. So yeah, I'm just trying to explain some of the information given here, right? So we are asked, determine the effect of the change in credit terms that advise High Street Limited on the feasibility of the new terms. So for this particular question, to decide whether or not to implement these credit standards, we take to get the change in profitability, which will make us decide whether or not to implement these credit standards. We take the change in gross profit, whether it's positive or negative, plus or minus the change of investment in trade receivables, plus or minus the change in bad debts, plus or minus the change in discount. So the signs on these changes depend on whether the change in gross profit has led to an increase in our gross profit or not, and so forth. So I'm going to explain how we decide whether each of these signs is positive or negative. So firstly, the change in gross profit. This one, we simply take our gross profit margin and we multiply it by our new sales minus our and we subtract our new sales minus our existing sales to get the change in sales. Then we multiply by our gross profit margin. So clearly we can see that if our sales went up from 90 million to 100 million, multiplied by the gross profit margin of 50%, it means that our gross profit went up by 5 million. So it means when we substitute 5 million into our formula, we'll substitute it as a positive. Then the second item, our bad debts. We've been told that our bad debts are going to go up to 9% of sales, whereas they are currently 8% of sales. They're currently 8% of sales, and then they're going to go up to 9% of sales, right? So because of that, to get the change in bad debts, we say 9% times our new sales minus 8% times our old sales, and we get an increase in bad debts of 1.8 million. An increase in bad debts is bad, so it means we're going to put this as a negative into our formula. If our bad debts had decreased, we would put this as a positive because a decrease in bad debts would be a good thing. Then the next thing we look at is change in discounts. So we've been told that the company wants to change terms to 10/30 net 60, meaning you get a 10% discount if you pay within 30 days. And we've been told that because of the discount on offer for early payment, sales are going to go up to 100 million. and half of customers are going to take this discount. So it means half of customers are going to get a 10% discount. So currently there's no discount. And then if these terms are actually implemented and taken up, it means that 50% of customers are going to get a 10% discount on sales of 10 million, which means that our change in discount is going to be 5 million. And we know that when discount increases, this is a bad thing because we are discounting sales. So we are also going to put this as a negative. So an increase in discount, we put that as a negative. An increase in bad debts, we put that as a negative. An increase in gross profit, we put that as a positive. So the opposite is true. Decrease in gross profit as a negative, decrease in bad debts as a positive, decrease in discount as a positive. The last item, we have to calculate the cost of investment in trade receivables. To calculate the cost of investment in trade receivables, we take the change in our average collection period times our current sales over 365 plus the new average collection period times change in sales multiplied by 1 minus our gross profit margin divided by 365. And then the answer we get here, we multiply by the cost of funds. So the change in average collection period, our average collection period, it's going to go down to 70 days, whereas it's currently 150 days. So we just subtract that. Don't worry about the sign here. We ignore the sign, just find the difference between the current and the new, whether the ACP has gone up or go down. I'll explain that further. So the change is 80. Current sales is 90 over 365 plus our new average collection period times the change in sales, which is 100 minus 90 times 1 minus the gross profit margin over 365. Then we multiply that by the cost of funds and we get 2.0685. So how do we decide whether the change of investment in trade receivables is positive or negative, right? So what happens is that if our average collection period has gone down, has decreased, as is the case in our question, it means that the change of investment in trade receivables, delta I, is positive because less of our money is now being tied up in accounts receivables. If our average collection period goes down, it means that we have less trade receivables on our balance sheet. And because of that, it means we've got less investment in trade receivables. So it means that in our formula, we put the change of investment in trade receivables as positive. So it means this would be positive as you're seeing here. However, if our average collection period had increased, it would mean that more of our money is now tied up in accounts receivables. So therefore, we would put the change in investment of trade receivables as a negative. So in this case, because our average collection period has actually gone down from 150 to 70, it means this answer that we got here, we put it as a positive into our formula. So then we can now calculate our expected change in net profit, which is the change in gross profit as a positive because gross profit has gone up, which is good, plus the change in investment of trade receivables as a positive because our average collection period has gone down, which is good, minus the change in bad debts, which we put as a negative because our bad debts has gone up, which is bad, minus the change in discount, which we put as a negative because an increase in discount is bad. And then we get 0.2685. And then since the change in profitability is positive as a result of implementing the new credit standards, it means that it is worthwhile to implement these credit standards as they will increase our profitability. Okay. Then 3.2 says Sardine Canneries Limited is planning for 2023, and once they estimates the funds they will require, the company has total assets of 2 billion, total liabilities of 1 billion, sales of 125 million, and net profit margin of 20%, and a dividend payout ratio of 50%. The company expects sales of 250 million in 2023 financial year. All assets and liabilities are considered spontaneous and increase in line with sales. A special dividend totaling 5 million rand will also be paid out to shareholders during 2023.
estimate the company's need for funding for 2023. So in this case, we just use the following formula, whereby the funding required is simply equal to our current assets multiplied by the expected assets minus, multiplied by expected sales minus current sales over current sales minus current liabilities multiplied by expected sales minus current sales over current sales minus this should be our net profit margin of 20% times the expected sales times 1 minus the dividend payout ratio, in this case, which is 50%, minus the spare capacity plus the special dividend. So it's known as the percent of sales approach to helping us estimate the expected needs in the next financial year. So we can substitute everything into our formula, making sure we substitute the assets and liabilities carefully, changing the billions into millions. 2 billion in millions is 2,000 million. 1 billion in millions is 1,000 billion. Substitute everything correctly, and then we get 980 million as the funding required. Just remember how to account for spare capacity. We subtract and we add the special dividend. And in this particular case, we are dealing with millions. So just remember to write 980 million there. Okay.
And then the final question here was a 5-mark question under 3.3. So this question says, Bell Limited manufactures Bell sacks for the transport of maize on a very large scale, and the company has experienced volatile short-term funding requirements over the past year. The management of the company wishes to change the way it funds its short-term funding requirements of 10 million rand. Currently, the company has an estimated long-term borrowing cost of 3% variable, access to a short-term facility at a cost of 3.5% capped at 3 million, and a revolving credit facility at a rate of 4%. Okay, you might remember some of these concepts from FIN4702 if you studied with UNISA, or if you did any short-term working management course, if you studied with a different university. They do cover these concepts in the undergraduate curriculums for financial management, even funding requirements, permanent and seasonal. But the way it's covered in the honors module is slightly different. But I'll try to take you through this question. It's only a 5-mark question, so it shouldn't take us too much time. The management of the company has further determined that its permanent funding requirements are 70% of its total short-term funding requirement. The management also decided that 1 million of capacity on either the short-term facility or the revolving credit facility should be left unused and kept in reserve for emergency use. It was recently discussed at a management meeting that the company should change from its current aggressive short-term financing plan, as it has run out of capacity more than once over the past year. Consequently, costly quick access to short-term loans had to be arranged to make up the shortfall. Okay. Determine the least costly approach the company should take to finance its short-term financing needs. Then briefly discuss the advantages and disadvantages of this approach compared to the current approach followed by Bell Limited. So the solution that I gave here, I tried to explain in detail as much as possible what the approach was in determining this particular solution. So in this particular case, we are told that the short-term funding requirement is 10 million, right? So the idea is you can have an aggressive short-term financing policy. With an aggressive short-term financing policy, that's when you need to finance your assets. But what you do, you need to finance your operating assets and so forth. But what you do, you rely heavily on short-term finance. In other words, rather than going for long-term loans, you opt for short-term loans to help you to finance your operating assets and your operating assets and so forth. So based on that, you will opt rather to use short-term financing facilities that you have. So currently, we are being told that currently this company is employing an aggressive financing strategy. Currently, that's what this company has, right? So they want to try to, currently you see they have an aggressive short-term financing plan, but there's a problem with this approach in that you are relying on short-term finance. So because it's short-term finance, the money can run out quickly. You borrow it for a short term, then you have to pay it. So you can end up running out of capacity. So what the company wants to do, it wants to rather opt for a more conservative approach rather than this aggressive approach they've been using, right? Because it's proving a bit expensive when they want to raise short-term loans once they run out of funds. So the current cost, based on the aggressive policy, the company is going to utilize the. Okay, so with the aggressive policy, what the company will do, the part of the needs will be met using the short-term facility. This is a short-term financing option. So they'll finance part of their needs using the short-term facility. And then that's 3.5% times 3 million. Remember, they need 10 million. And then they will also utilize this revolving credit facility. But remember, they want to leave a capacity of 1 million rand on either the revolving credit facility or the short-term facility. So we would rather opt to leave the 1 million rand on the revolving credit facility because it's got a higher interest rate compared to the short-term facility. So we will use 6 million from the revolving credit facility and leave 1 million. So that means we will have raised 3 million plus 6 million from the revolving credit facility and the short-term facility. So that's going to leave us with a need of 1 million. And then that need of 1 million, we will have to get it from the long-term borrowing, as is the only other form of finance that's left. So that will mean that the current cost based on the aggressive policy is 375,000 rand. And then based on the more moderate policy, the more moderate policy will be a bit more conservative compared to the aggressive policy. We won't be relying as much on short-term finance. We'll rather rely a bit more on long-term finance. So here we are told that the management has determined that its permanent funding requirements are 70% of its total short-term funding requirement. So what we will do with the conservative approach, 70% of our funds, our short-term funding requirement, 70% of it, which is permanent, we will rather have long-term borrowing associated with that, right? So we'll say 70% times 10 million, which is our total need. 70% of it is permanent. And then we are going to use long-term funds to help us to finance that permanent need, right? And then 30% is going to be financed using the short-term facility because it's going to be seasonal. There'll be times we need it, times we don't. So we'll then say the remaining 3 million, which is 30% of 10 million multiplied by 3.5%, which corresponds to the cheaper source of finance. So we'll start with the short-term facility rather than the revolving credit facility. Yeah, so we'll still have 7 million in the revolving credit facility, but we'll use the short-term facility. And then that will give us a cost of 315,000 rand. And then clearly we can see here that the least costly approach is this conservative policy. We can call it the moderate policy in this case, of the conservative policy, because this policy has less risk of technical insolvency. Okay, there's less risk that we'll run out of money in the short term compared to the current cost based on the aggressive policy. So, however, this approach might be less profitable if the variable cost on the long-term funds increases. So please note, the variable cost on the long-term funds is currently 3%. So we might say, yes, this approach has benefits in that there's less risk that we'll run out of funds. but there's always a risk that this variable percentage of 3%, it could change, it could go up. And if it goes up, it could negatively affect our profitability. So yes, we are going to opt to change to the more moderate policy. I'm just using the words moderate and conservative here interchangeably. I know that in the textbook there's actually a conservative, moderate, and aggressive policy, but in this case, I'm just using them interchangeably, right? Because this moderate approach is more conservative than the aggressive approach. So you can just use either one of those words, maybe just conservative, it's also fine. So this approach, as much as it has a lower cost currently, and it's got less risk of technical insolvency, there's always a chance that the variable cost could go up. And if the variable costs go up, there's always a chance it could affect our profitability. And you're now tied up in a long-term loan with a higher interest rate. Whereas the current cost, these rates are capped. They won't change. So that's a bit beneficial. But of course, there's always the chance to run out of funds and then you need more funds, which can negatively affect you. Okay, so please note, yeah, I did use moderate policy, but you can just change this to conservative and then just say conservative throughout. Or even if you say moderate here, just change this to moderate throughout. The question would still be marked correctly. The idea is that whatever we're doing here under proposed is going to be more conservative than aggressive. So whether we call it moderate or conservative, the professor will still understand what you're trying to say. Okay. So I think for now, we've covered about half the paper. And I think we can stop there with part one of the revision, going through this paper. In the next class, I'll take you through the remaining parts of the paper. But for now, we can stop here. I hope the revision class has been helpful. And as usual, if you have any questions or queries with regards to anything covered in this class, please feel free to let me know. I won't always be able to get back to you quickly, but I'll always try to do so as soon as I can. Thank you very much.